We're welcoming now Rahul Arora, CEO of Nirmal Bang Institutional Equities. Rahul, very good morning to you. We're just thrown off with what we're seeing with Tata Consumers. And the numbers, I mean, on the face of it, just didn't seem to justify what we're seeing on the streets. Did you see the positives of it?
Well, good morning, Tamanna. Thank you for having me on the show. So obviously, for the valuations, the results were very disappointing. I think if you looked at the gross margins and the way they declined by about 250 basis points. And I think the problem, Tamanna, is that this is one of the few consumer companies that has single-digit ROE, ROCs. I think that's the big challenge. And the call, if you remember when Sunil D'Souza was appointed CEO of Tata Consumer, I think even before he joined, the stock had doubled because of what he had achieved at Whirlpool. But I think the packaged food space itself, when you look at Nestle, Britannia, and Tata Consumer, is certainly the most exciting in the consumer staples place when you look at the other staples that are on offer. But I think given these results, although they have said that by the third quarter, the margin should return to 15-16%, I think that, without wanting to sort of ponder too much in terms of giving it a punchline, the street will take it with a pinch of salt, if you know what I mean. So I think, people will wait at about 45 times FY27 for the kind of results that they gave. I think even the volume growth was nothing to write home about. And this may be true for the entire consumer staples universe. So for an 8-9% ROE, ROC business paying 45 times when you're seeing margin pressure and no volume growth, I would be tempted, I think, for the foreseeable future, if you wanted to play the packaged food space, to move out of Tata Consumer into something like a Britannia or a Nestle.
A pinch of salt is definitely what the street is looking at. So it's paired off from its opening gains and maybe a pinch of salt being taken there. But in that packaged space, HUL, Nestle, Britannia, you mentioned Nestle and Britannia as ones that you like. How are you looking at this entire pack, Rahul, in terms of this quarter? Because obviously we're waiting for some of those numbers to come. What's going to be key in your view?
So I think, Tamanna, the one thing that's turned for sure, and you're hearing this from the commentary of most consumer companies, is that rural has now started to perform better than urban. So first it was urban, then you heard this new phrase, which was urban, and now it has now moved to the rural side where urban sort of becoming a bit of a challenge. So I think obviously there is, the anticipation that the monsoon will play out as well was anticipated before it started. The various schemes that the government of India has put in place for giving, money in the hands of the poor. You do have a very major state election just 3 to 4 months down the line in the Hindi heartland. So I think all things considered, places that have a higher rural component may not be a bad play. That being said, Tamanna, I think what we need to keep at the back of our minds is penetration levels are very high. I think if you look at soaps, detergents, most of the staples, they have 90% plus kind of penetration levels. So you're not going to get serious volume growth unless you compromise on margins. I think if you looked at the last decade as well, the reason Lever went from 300 to 3,000 was not because they grew their top line magnificently. Their top line CAGR was just about 8-9%, but they managed to take their margins from 13-14% to about 24%. Now, the challenge is that these margins from here, from 24, cannot go to 30. And in that backdrop, if you're not going to sacrifice margins to buy growth, something like what you're seeing in IT, for example, then you're in for a bit of a challenging sort of environment. That being said, I think consumer discretionary is still holding out very well. I think we were very, enthused by the results that United Breweries put out, that Indian Hotels put out, that Zomato put out. So I still think that the K-shaped recovery or the K-shaped consumption pattern in India is still, underway. You can see that in the numbers of, say, iSure. You're seeing that in premium real estate with what DLF has done with its last launch and, lapping up 11,000 crores. So I think premium consumption is doing well. And rural, I think it's that middle point that I would want to avoid, both because there is no volume growth and it's so rural dependent, and the fact that penetration levels are as high as they are. That makes valuations very challenging in this backdrop.
Rahul, good morning. Neeraj here. Lest you think that we are only going to talk consumers with you today, but it's just that the kind of numbers that are coming out in the news flow prompts us to do that, right? Mm-hmm. So two buckets that I want to discuss with Rahul. You guys come out with a note recently on the platform companies, right? Eternal and Swiggy. The rallies have been fairly swift post results. What do you make of the results, the internals, and whether the valuations leave room on the table?
Morning, Neeraj. I think optically, if you looked at the valuations of both these companies, you wouldn't touch them, right? Because these are companies that are valued on price to sales, which is a very scary metric to start off with. Zomato is coming to you at nearly 6 times price to sales. Swiggy is coming to you at about 4 times price to sales. So optically, if you didn't know anything about these businesses and someone just showed you a sheet of paper and said, would you buy these companies? You'd say no. But that being said, the point I was making to Tamanna about consumer discretionary, I think if you looked at the gross order value, of the way Zomato has grown its business is remarkable. I still think that this company can grow 35% plus for the next 2 years. I think the way they have spoken about managing their inventory, Neeraj, which is already 3%, incremental to their business from what it was last quarter, that is likely to add an extra 1% to their margins, which the street is very enthused by. They have raised about $1 billion worth of capital just about a quarter back. So they are flush with cash to counter any sort of competition. I think this entire issue of discounting, Neeraj, has come down dramatically. That's a good thing from a platform fee perspective, and I think companies like Rapido and the things that they're doing with flat fee, and the kind of things that other QS the people, the Zomatos and Swiggies will have to sort of align themselves with that. I personally think, Neeraj, when you look at both the food delivery, which is currently at what, about $7 billion or thereabouts, I think as per a Cantor report, that's likely to go to $21 billion in the next 5 years. Now you're talking, if that happens, you're talking about a CAGR of north of 25-30%. Same with quick commerce. I think if you look at both Instamart and Blinkit, those are expected to go up 4 or 5x as per that same Cantor report in the next few years. That you're talking about a 65-70% CAGR in terms of quick commerce as well. I think the good thing, Neeraj, for both these companies is that they have understood what cash flows are and the road to profitability is. It's very different from, say, when a Zomato listed, when it was just about acquiring customers and growing your order values and discounting. So I think that realization that's come in has got institutional investors very enthused. The fact that Zomato adjusted EBITDA agreed, but has turned profitable both even on the PAT level. And I think Swiggy's losses, which were about 3,000 crores last year, our own expectation is that should half to about 1,500 crores by next year. So as you have these losses coming down, cash flows going up, them raising funds to counter competition, reduce discounting, manage their inventory on their books to reduce third-party dependence, then I think you're talking about a situation where you have a duopoly like PVR Inox, and you say, okay, can the disruptor really be disrupted? And if the answer is no, then these valuations may very well sustain. On a relative valuation basis, Neeraj, we prefer Swiggy because, at the start of my answer, I said that Zomato is trading at, say, about 6 times price to sales, and Swiggy at about 4 or a little under. So that valuation gap is a little too stark for both businesses that will grow in somewhat similar metrics. Obviously, Zomato's overall numbers are 30-35% higher, but the rate of growth should by and large be similar. So we like both the names, but just as a relative valuation play, we'll play Swiggy.
And Rahul, you track QSRs for as long as anybody that I remember individually as a bucket, while you, of course, are the CEO. But I just wonder if you guys as a house have any thought on Westlife, Sapphire, etc., because the numbers are just not coming.
Mm-hmm. So I think, Neeraj, the problem here is the operating environment is very challenging. I think if you looked at Sapphire's numbers, obviously they were negative on a negative base. Westlife was just about 0.5% same-store sales growth. So there's nothing to write home right now in terms of the operating environment. I think what is something like a Westlife is doing, I think if you looked at the quarterly results, they have now expanded their drive-thrus to almost 25% of their stores. I think they've gone over 100 drive-thrus in India. I think now their McCafes are covering almost 80-85% of their stores. So I think when that recovery does come, and maybe Swiggy, Zomato have a role to play in it. I think, McDonald's is a business which is very different from some of the other businesses, Neeraj, because it's more a dine-in model. The average store size of a McDonald's would be about 2,500-3,000 square feet. Whereas, say, if you looked at the Jubilant or somebody who relies on delivery, their store size is maybe 800 to 1,000 square feet. So what that basically means is if the number of people going to the malls is not that much, and this may be an offshoot of the fact that Bollywood hasn't done too well and the occupancies are not too good, or the fact that people have moved to buying, accessories, personal products and shopping items, clothes online. So if the footfalls in the malls come down, which is where, say, a McDonald's is very prevalent, it's obviously going to have an impact. So that makes delivery that much more important. So I think for a McDonald's, you probably wait for an overall revival, both in terms of the footfalls as well as how, the new initiatives on drive-through and delivery are shaping up. But I think the operating environment, Neeraj, at this point is a bit challenging. Going back to the point I was making about margins in consumer staples, I think if you looked at McDonald's about, say, 10 years back, it was operating at 55% gross margins. That number is up to about 72%. It's within striking distance of what a Jubilant Foodworks operates, which is the best in class in the sector. So I don't know how much room you have in terms of growing your margins also from here. But the good part is, even for a dine-in business, someone like a McDonald's is giving you about a 15-20% ROE, ROCE, which is not too much lower than, say, what dine-in businesses give you. So I'd be a bit wary of the others beyond these two, Neeraj, because I think a lot of them have issues on capital allocation. I think they have acquired franchisees in countries that are politically sensitive. Countries like Turkey, Indonesia, Thailand, Sri Lanka. So I think from an ROC perspective, if something was to go wrong there, that'd be a bit of a challenge. But I think I like the model that McDonald's has followed in terms of diversifying into a higher gross margin business in beverages, and Jubilant just from the point of view of scale and cash flow. So you'll have to be a little patient with them. I don't think valuations justify buying the stocks right now. But if you must take a slightly longer term view, at least 2 to 3 years, because my sense is the next 2 to 3 quarters could still be very challenging for these players.
Okay, thank you so much for that, Rahul. So we've talked a lot about consumption, staples looking fine, quick commerce overvalued, and the word is still out there as far as your fast dining is concerned.